Yesterday, I did a video on Iris Energy, ticker symbol IREN. And so as a result of that and my interest peaked in Iris Energy, I went and watched a hour-long interview with the CEO, Daniel Roberts. I want to share that with you because I operate under the opinion that if I can find a good stock, a non-discovered stock, and if I can find a good CEO, hopefully the founder, and find it before Wall Street finds it, I can have an exponential growth. I'm buying today a stock for Iris Energy for $13 a share that I am confident will be $60 a share in the foreseeable future. Why is that? Because they've figured something out that Wall Street hasn't, nor has anybody else. What they are is a Bitcoin miner. They own energy. That is the key. They own real estate and they own energy. And those are two shortages that the data center business is facing. And the data center business includes the biggest the companies in the world. That is Apple, Amazon, Google, Microsoft, and Meta. They are going to run into a problem with energy. And Iris Energy, because of their Bitcoin mining, is sitting on a lot of energy. They mine Bitcoin. They spend $17,000 per Bitcoin right now in energy, in electricity, and then turn that into what is right now about a $60,000 Bitcoin. Very profitable. They sell it the next day, and then they go out and buy more energy. They are building their capacity to not only mine Bitcoin and sell it at a profit, but also answer the screaming need by the largest companies in the world for data centers. So what I want to do now is turn it over to Daniel Roberts. He's going to use words you don't understand. I suggest you watch this video over and over because this just might be the best investment you'll make in 2024. And you better get it quick because the world's going to wake up to this new way of making money. Mining Bitcoin, selling Bitcoin, and then buying energy capacity to fill the needs of big data and artificial intelligence and generative learning. You watch this, you understand this, and you will be a better investor.
So maybe stepping back, our prior guidance was for 10 exahash of operating capacity by 30 June this year and 20 exahash by the end of calendar year 2024. Around that time, the earnings call, we announced that we had brought forward the 10 exahash of operating capacity and in fact had hit it at that point in time, so about 6 weeks early. And we also upsized our year-end guidance from 20 to 30 exahash, along with outlining a transaction that we'd entered into with Bitmain for supply of those units. Predominantly S21 Pro model, so the latest generation efficiency, and once installed over the coming 6 months, would drop our fleet efficiency down to around 16 joules per terahash. So this is 510 megawatts of data center capacity. You might recall that it previously was 460 megawatts. And a couple of weeks before that earnings announcement, we actually upsized our year-end guidance for data centers. Basically, the team's got a really good run on. We've got a good cadence. We're getting ahead of the curve in terms of that delivery. And we're able to bring forward an extra 50 megawatts of capacity into the current calendar year. And that was part of helping to facilitate that upsize in year-end guidance from 20 to 30 exahash. Yeah, look, obviously it was a good result on the financials. We've tried to keep it very clean. We've got no debt. We've got no Bitcoin revaluation. It's operating cash flows. And as you mentioned, 8.6 million of positive NPAT for the quarter. I think our 9 months number was about $48 million in positive operating free cash flow, which we're reinvesting into growth at this stage. So we're hoping to position the business, as we always have, as quite a clean data center mining business that's relatively easy to understand. And you do see those FASB numbers come out, and at times I feel sorry for investors having to try and interpret all that data and all the different ways different people present their financials, but we really do try to make it as transparent and as simple as possible for the end user. So in terms of raising the hash rate growth target, look, one way to think about it is just look at the end outcome, 510 megawatts of data center capacity, and then look at the models of the miners we've got and their efficiency, and you can see how you get to the 30 exahash. So we've set an average fleet efficiency of 16 joules per terahash. Multiply that by 30 exahash, you get 480 megawatts. You've then got 30 megawatts as like PUE, redundancy, and just a little bit of a buffer. So if you backsolve from that perspective, you can see how we get to that. In terms of the specific trajectory to get there, we haven't disclosed a huge amount of detail at this point, other than to say 20 exahash by the end of Q3. So by the end of September, about 3.5 months' time from now, we're saying 20 exahash. And then the following 3 months, there'll be another 10 exahash added to take us up to that 30. There's a combination of upgrades to existing machines in situ in British Columbia predominantly, but a little bit in Childress. So the S19J Pros. So they're 29.5 watts per terahash per terahash, joules per terahash. In terms of efficiency, upgrading them to predominantly S21 Pros at 15 joules per terahash, you're basically getting 2 for 1. There's effectively a 5.5 exahash gross up just from upgrading the S19J Pros, right? We've got 5.6 exahash, don't quote me on that, but I am on the record. It's around that, which effectively will double to around 11 exahash. So that 10 of operating capacity goes to 15.5 without us doing a thing other than unplugging some computers and plugging some new ones in. I understand that those targets look bullish and they look ambitious, but as you know, like, we don't publish something unless we're super confident that we'll at least hit it. And like, in fairness, this isn't that difficult. Like, the team, as we've said, ever since the IPO documents, and not many people listened then, and there's more people listening now, like, this team has collectively delivered tens of billions of dollars in infrastructure projects globally. To go and continue building out cookie cutter, fixed design data centers, which are large buildings with, you know, preset designs, existing contractors, existing internal labor, and just be punching them out each month. Like, I'm sorry, but it's not that hard in terms of the structures, the processes that we've put in place relative to previous projects and businesses that a lot of these guys have been involved in. So for us, it's not about 30 exahash by the end of this year. Like, I spend none of my time on that, to be honest. Like, very, very little. It's a minute fraction. Like, we are thinking about next year. What are we delivering in Q1? What are we delivering in Q2? What happens when our 1.4 gigawatt site is energized? What preparation can we do now in terms of building out data center infrastructure? Is that going to be data center infrastructure for Bitcoin mining? Is it going to be data center infrastructure for more AI cloud services? What happens, and this is what I'm spending more time on, what happens when we run out of power at that site? That's the 1400 megawatt site. Where do we sit in 2027, 2028, 2029? Where's our development projects? Where are the connection agreements? Do we need more land? Do we need more power? And it's always kind of thinking that 3, 5, 7 years ahead, because as we've seen, you can't click your fingers and plug a toaster into a high voltage transmission line. The world doesn't work that way, and people are learning it the hard way. We've said for years, like, this stuff takes a long time. You've got to go and find land. You've got to put in your connection request. It takes years. And what we've seen is a compounding of that process beyond our expectations in the last few years, where prior processes that might take 3 to 5 years, anecdotally, are now taking 5 to 8 years in terms of securing that power. So, okay, if it's 5 years, gee whiz, that's 2029. At least we've got a head start on a number of other development projects. That's all right. We've just got to get cracking and make sure we're not short of power in 2028. And I think the market's now getting comfortable with this. And what we should say is ATMs are not an issue in traditional finance. In fact, we're told by the investment banks that half, so 50% of equity capital raised in US capital markets is from ATMs. I don't think the issue is with ATMs as an instrument. I think the issue is when investors perceive that companies are using ATMs without transparency, without accountability, and perhaps not utilising that funds for accretive growth within the company. So we've tried to be ultra transparent on that in terms of sources, uses of capital. Now, that's not to say that we're going to use the the full ATM. We probably will. It's a matter of when, at what share price, right? We've seen the re-rating start to happen. I think our share price is almost 2x since the earnings announcement. And it feels like on a comparable basis, there still might be quite a little bit more room to run. But again, like that's out of my hands to a large degree. That's Mr. Market. But the point is, when we can continue to grow at a capex cost of $30 million per exahash of capacity, which the market is valuing at multiples of that in terms of market value, then surely you do that all day long, right? If you can. And this is the point you were making earlier, like you can't. People don't have the power, they haven't got the team, they haven't got the infrastructure, they haven't got the ability to grow. And that's perhaps why there's such a disconnect between the cost of construction and the market value. And then you look at it the other way and say, well, that's the market. What are the fundamentals? And the fundamentals we've published, and we've tried to be, again, ultra transparent. 1 exahash is $30 million of capex. You know, again, at about a $65,000 Bitcoin price, and it's now higher at 70. That's a revenue line of around $19, $20 million. Electricity costs of around $4.5 million. You're at a hardware profit, so gross profit, revenue minus electricity costs, of over $15 million on a $30 million capex line. And that's free cash flow. That's cash that hits the bank on a revenue basis every day from the sales of Bitcoin. So you're looking at, 15-month payback on the ASICs and 24 months if you want to amortize both the ASICs and the infrastructure itself. So you can triangulate the metrics to work out what's accretive for shareholders. And you look at it through multiple lenses. And if you can grow, the numbers speak for themselves. Honestly, I've been almost shocked at how public markets work. Like, I've been a private market guy my whole life, unlisted businesses. As you know, I helped set up an unlisted private infrastructure funds management business in Australia. We grew that to around 6 billion in assets under management, ports, airports, wind farms, solar farms. You build your financial model, you build your business case, you lock in your contracts, and you value it. Like, people actually believe you because you demonstrate to them that you've got all the ingredients to build out long-term infrastructure. So people discount those future cash flows back and you've got a valuation. But coming into the public markets, it's been a very different experience. It's almost the other end of the spectrum. It's what's your next quarterly earnings number? And until I see that, I'm almost not going to believe a thing you say. And I don't know if it's skepticism around corporate CEOs and management teams and just this distrust of anything that they say. But it's been like a real awakening. And we've seen a lot of our early shareholders stay on for the ride because they believe it, they see it, they understand it. And it's not easy when the market's to sit in there going, we don't think there's value in 3,000 megawatts. We don't think there's value in the ability to grow fast when market conditions return. We don't see the value in you spending 2 years building out high voltage substations at this site called Childress for 600 megawatts when Bitcoin's $16,000 a coin. And all of a sudden the market changes and everyone goes, oh, hang on, like there's earnings. These guys might make money. And it's like, well, we kind of haven't changed a single thing in 6 years since we said this business. We tell you every time we do something. So it has been a big surprise in that regard. But, you know, I don't make the rules. Again, it's Mr. Market. So if the market wants quarterly earnings, then bring it on. It's going to be a fun 12 months ahead. But we're not dogmatic. Like, I change my mind 30,000 times a day with Will, right? Like, we're always challenging our thought process. Like, how do you optimize new information, new processes, new decisions? So, you know, I'll have this conversation probably weekly with Will, and we'll just debate the pros and cons. And like Bitcoin, my belief is Bitcoin is essentially inevitable. Once you cross that threshold and you understand that you can't create more than 21 billion and you can't stop it, it's game over. Like, this thing is just programmed to win. So like, there is no lack of belief in Bitcoin. In fact, I actually set up a business and have dedicated the last 6 years of my life to a business that revolves around Bitcoin. So to say I'm a bear on Bitcoin is a little bit of an odd statement. But step back and you say, well, let's go back to those maths that I just outlined. If you can spend $30 million and build out an exahash of capacity that markets value in excess of $100 million, I can't buy one Bitcoin for 70,000 and have that revalued 3x. But I can if I build out this data center capacity. So what's a better use of funds? Like, clearly it seems to me that the more accretive play is to build more capacity and compound that exposure to Bitcoin for shareholders rather than just buying a static asset and buying it on balance sheet. And until the ETFs came along, I understood that there might have been a strategy here around being a bit of a Bitcoin proxy and all in, but it just doesn't seem to be an optimal use of shareholder funds. Now, that's not to say that we won't hold some on balance sheet at some point. Personally, if we end up with a large working capital cash position, then sure, why not put some into Bitcoin if we're not going to use it? In the short term, it is a great store of value. It is a better savings tool than any checking account, savings account, treasury bond, etc. But the cash we have today is going into growth, which is turning that $30 million per exahash into $100 million per exahash for shareholders. And I just don't understand why any shareholder would want us to stop doing that and start buying Bitcoin instead. So like my personal thoughts are, if we're generating all this operating free cash flow and it starts becoming above and beyond our need for growth, or we want to demonstrate to the market how operating free cash flow positive we are, then look at things like distributions. Let other people hold this Bitcoin. Again, like if I'm holding Bitcoin on your behalf, where do I put it? Do I give it to one of these unregulated offshore casinos to hold on my behalf? No, like we've been through the Mt. Gox. We've been through all the FTX stuff. I don't want that problem. If you hold Bitcoin, you should cold storage it. If you're not comfortable cold storage it, then go to an ETF that has all the structures, the processes, the systems in place. So my personal view is if we are good at generating free cash flow, building out operating infrastructure and creating value for shareholders, and we wish to return some of that value to shareholders back, give it as a distribution so people can buy Bitcoin and hold it on their own behalf, or go and buy an ETF. But again, we're not dogmatic. We'll keep challenging that perspective, but that's probably where our current thinking's at. I'll be open. Like if we've got a compelling offer, of course we're going to entertain it. But equally, we see the value in the existing platform and the team and continuing to build out and this hyper growth trajectory that we're on. And look, we're speaking with a lot of investors now. Like the level of interest has really increased. Traditional funds, they're finding their ways to this sector because they're coming out from the data center shortage thematic, and they're kind of going through the process, speaking to the banks, the research houses, and saying, what does this all mean? Where's Microsoft going to get power? Where's AWS going to get power? And all of a sudden they kind of follow the breadcrumbs and say, hey, these Bitcoin miners have got lots of power. So, numerous calls with these guys. And it's interesting, right? Because I'll get on a call with one of them and they'll have just finished a call with another mining company who, I won't name specifics, but saying the CEO said, no, Bitcoin's going to $1 million, will never sell. So, well, okay, that's kind of interesting. But like, why be so fixated in your view? And I don't know whether people just enjoy having a job and running a listed company. That's curious in and of itself. But ultimately, if you can generate a lot of value from the assets, why not? And you've got a fiduciary duty to your shareholders to do so anyway. Yeah, so look, it's a strategy we're continue to be very optimistic on. It doesn't compete with Bitcoin mining. Just the power consumption is so low per unit of capex. So as we said, every $100 million of GPU capex uses less than 1% of our 510 megawatts of data center capacity that we'll have online over the next 6 months. That then generates, $40, $50 million of kind of hardware profit on that. So there's no opportunity cost really in terms of the infrastructure, the data center capacity. So it's really about funding and customers. And we see there's a real opportunity in this market around the cloud service. We understand a number of others are providing it. We feel like we've providing a service that is not only matching that, but anecdotally seems to be superior. And this is coming directly from customers themselves around feedback. The fact that we're 3 times faster on certain metrics than 8 other data centers, not Bitcoin miners, data centers. And there's a few reasons why we're speculating that's the case. I mean, from our perspective, we're just doing this thing properly. And then we wake up and say, oh, you guys are awesome. You're doing it really fast and efficiently. And so, well, why is that? So I can come back to why we speculate that might be the case. But from a strategy perspective, it's just keep doing more of it. While customers want these chips, we'll keep delivering it to them and growing that side of the business. It's a fantastic return on capital in terms of the 2-year payback. However, you also need to be conscious of hardware redundancy in terms of technological improvements. It's like ASICs, right? You don't necessarily want to be caught holding older generations. So you've got the NVIDIA H100s at the moment. They're still in demand, right? There's a good revenue line attached to them, but equally there's a trajectory over the coming years for upgrades to that. humanity doesn't still stand still. They're going to continue improving it. So how many chips do you want to buy? At what generation? What does the customer contract look like? And then what's the funding source? Sitting here today with our equity where it is in terms of market cap, the discussion we've just had, the prospect of perhaps having some very material revaluation over the coming few months as we continue to deliver more capital, is it prudent to heavily dilute at the current levels to grow this side of the business, or is it more prudent to be a little bit patient and just allow the current potential re-rate to continue on the trajectory it's on? And then you say, well, what about debt funding? And look, debt's a double-edged sword, right? It's accretive to shareholders when it's used well, but it also increases risk. So what are the structures that look like? We saw Core Weave raise $7.5 billion of GPU financing. We saw Lambda raise $500 million of financing. We own our data centers. There's no risk on finding data center capacity with us. So from a lender perspective, there's potentially a better credit story here from finding PowerPoints and being able to stand up this service. But what does the customer contract look like? How much risk are we willing to take on that as a business? How much risk are lenders willing to? And like I say to everyone, we're always in a rush. Like, we're always trying to do everything yesterday, but we don't feel pressure to make bad decisions. We're going to take our time to make decisions that are in the best interest of shareholders. And if that means waiting an extra month, then so be it.